Welcome to this video on how to avoid capital gains tax in 2026. We will break down the 2026 rates, inflation-adjusted brackets, and exact strategies you can use to reduce your tax bill. There are two types of capital gains. Short-term gains, held for 1 year or less, are taxed as ordinary income up to 37%. Long-term gains, held for more than 1 year, have preferential rates of 0%, 15%, or 20%. Inflation adjustments for 2026 have raised the long-term capital gains thresholds. For single filers, the 0% rate applies up to $49,450. For married filing jointly, it's up to $98,900. For married couples filing jointly, if your total taxable income is under $98,900, you owe nothing on long-term capital gains. Remember, gains stack on top of your ordinary income. High earners must also consider the 3.8% net investment income tax. Here are 4 strategies to consider: tax loss harvesting, the primary residence exclusion, a 1031 exchange, and donating appreciated assets. Strategy 1. Tax loss harvesting. Offset your gains with losses. Losses cancel out capital gains dollar for dollar. You can also deduct excess losses up to $3,000 of ordinary income per year. Remaining losses can be carried forward. Strategy 2. Primary residence exclusion. If you've lived in your home for 2 of the last 5 years, you can exclude gains from taxes under Section 121. Single filers can exclude up to $250,000, and married couples filing jointly up to $500,000. The Section 121 exclusion is a powerful tax break for homeowners. It offers tax-free money with no income limits and no phase-out. Strategy 3. The 1031 exchange. Sell an investment property and reinvest the proceeds into a, quote, like-kind replacement property to defer your capital gains tax entirely. The 1031 exchange allows you to continuously roll over properties and defer capital gains. Upon your death, your heirs receive a step-up in basis, wiping out those deferred taxes. Strategy 4. Donate appreciated assets. By donating stock or crypto that has appreciated in value, you can deduct the full fair market value and pay 0 capital gains tax. Here is a comparison of the 4 strategies, noting who they are best for, the tax benefit, and the key limits for each. Be aware of the net investment income tax, an additional 3.8% surcharge for high-income taxpayers. This applies when modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married filing jointly. The holding period is crucial for capital gains. Waiting 1 year and 1 day before selling can drastically cut your tax rate, potentially from 37% to as low as 0%. Holding your assets for just 1 year plus 1 day is the simplest move in capital gains planning. This extra day of patience can result in significant tax savings. The 0% bracket provides an opportunity to strategically realize gains and pay nothing. This is sometimes called gain harvesting. One of the ultimate long games in tax planning is the step-up in basis. Your heirs inherit assets at their current market value, and deferred gains are wiped out, never taxed. Tax planning is everything. The right strategy can completely wipe out a massive tax bill, so don't underestimate the power of strategic financial moves. Key takeaways for 2026 include holding assets for over a year to unlock preferential rates and harvesting losses. Also, use Section 121 for home sales and 1031 exchange for real estate. Navigating capital gains rules is complex. However, the right strategies help you stay ahead and keep more of your hard-earned money. Always consult a qualified tax professional before implementing these strategies.